In lesson 3, we will cover the roles of catalytic capital. In other words, where and when catalytic capital is needed. The 3 main roles of catalytic capital were outlined in an important report by Tideline in 2019, which explains the role that catalytic capital plays in different stages. The first stage is seeding, or the risk and validate early stage innovation. The second one is scaling, by realizing economies of scale and reaching new geographies and population segments that commercial capital alone will not fund. Especially at this stage, catalytic capital can also be used to risk and leverage investments from other investors. This is done through blended finance structures. The third one is sustaining an investee that requires a subsidy on an ongoing basis, for instance, to preserve the mission of a company. Let's take a closer look at each of these roles. In the seeding role, catalytic capital can back enterprises and investment managers that are advancing the frontiers of impact, but with neither a track record of their own nor ready comparables that will be required to attract mainstream capital. Catalytic investments with the seeding role can help achieve impact that otherwise could not be achieved, but they also involve a high level of uncertainty and therefore risks, which dissuades many investors, even where there is a promise of market rate returns. And yet, bridging this gap is key to building a pipeline of the next impact investment opportunities and resolving the pressing challenges that face people on the planet. Catalytic capital can help break this impasse by accepting the disproportionate risk element and entering where others fear to tread, ultimately seeding a wider and deeper range of opportunities in the future. At Tonic, we ran focus groups in 2021 to understand the attitudes of high net wealth individuals and family offices investors towards catalytic capital. And we noticed that many investors intentionally take the disproportionate risk element, especially at the seeding stage, more so that they openly accept concessionary return. In some instances, even deal with disproportionate risk may turn out highly profitable, notwithstanding the high level of risks involved. However, the concessionary return element will become more and more visible over a greater portfolio of seeding stage investments that accept a disproportionate level of risk. At the enterprise level, an example of seeding investment might be investing in an early stage venture using a novel business model to provide beneficial services, such as affordable high-quality healthcare or education to underserved communities. Let's take a look at a regenerative agriculture example. Renature is a company that promotes, designs, and implements regenerative agroforestry to bring back nature into agriculture. It restores landscapes, secures the economic resilience of farmers, and also tackles climate change. In 2020, the company was presented to Tonic members. At that time, it only had 2 pilot farms and limited revenues. In other words, it still lacked proof of concept, and many members had concerns about scalability. This is because the company was building pilot farms at their client site to actually teach them practically how to transition. So there was the need to build a new farm for every client. Yet Tonic investors knew that this model could be incredibly transformative to inspire and enable transition. They also knew that without Renature that brought schools and training facilities, farmers would have known how to make this challenge, and so the transition will not have been possible. It is a concessional investment because there is an unproven model. Only 2 pilot farms at the time of investment, so investors perceived high scalability risk because of this capital expenditure needed to build a farm at the client site. It differs from commercial expectations because such a model might have been easily overlooked by commercial investors who have demanded greater proof of concept. It is needed because without pilot farms to explain practically to the farmers how they can adopt regenerative practices, the farmers wouldn't have had the training necessary to make the transition. And the impact that it catalyzes is to validate a new model. At the time of the investment, the company only had 2 pilot farms, but 2 years later, the company had projects all over the world. At the fund level, examples can include investing in funds, pursuing innovative strategies, or the first fund from a first-time fund manager that is transcending historical and structural exclusion. An example of it is APIS and Heritage Legacy Fund 1. The fund uses the employee-led buyout model to buy out companies with large workforce of color in the United States, and then turns them into 100% employee-owned businesses in about 5 years. This creates wealth for the people who earned it, the workers. The workers can now build equity and improve their retirement savings. Peace and Heritage also provides the workers with management training to build a culture of collaboration and empowerment. This ownership culture is shown to reduce turnover and improve the satisfaction and productivity, and that leads to better growth and healthier margins. You can see their model in this image compared to a traditional leverage buyout transaction where the buyers put down some equity and uses that to complete the transaction. Happy's and Heritage leverage a smaller percentage of that as well as a note from the company seller, and it took a mezzanine position for about 5 years. At the end of their investments, the fund gets the mezzanine investment paid back, and the senior debt are paid off or refinanced. This leaves the employees in a better equity position and transfers wealth to them because they take over the equity of the company. It is concessionary because this was an unproven model. The employee stock ownership plan was validated in traditional industries, but never in the impact investment space. And it differs from commercial expectation because this model takes on risks that are not compensated with extra return. It is needed because there is a significant wealth gap in the retirement savings for communities of color in the United States, addressing social and historical structural barriers to wealth. And the impact that it catalyzes is to reach an underserved population and validate a new approach. Then there is the scaling role. The scaling role picks up where the seeding role leaves off. Even after pioneering impact enterprises and investment managers demonstrate early successes, they can still struggle to attract mainstream capital, as their track record might still be limited, their size still subscale, and the markets that they play relatively underdeveloped. In these cases, Catalytic Capital can step in to help them scale and expand their business or strategy, or support other players in replicating these models and strategies to reach further situations, population segments, and geographies. In many cases, such investments are also structured and deployed in ways that de-risk and mobilize additional investments from mainstream investors. This is done typically through blended structures. When scaling, catalytic capital providers might accept either disproportionate risk by taking a subordinated position in the capital stack, or concessionary returns, such as a concessionary rate, fixed coupon, or some combination of both, depending on the needs and constraints of the mainstream investors that could potentially be drawn in. Let's take a look at a scaling example. An interesting investment made by Minitech members is Goodwell Investment. It is a venture firm focused on financial inclusion, financial technologies, and inclusive growth in sectors providing basic goods and services and income generation opportunities to the underserved. Since 2006, Goodwell had raised 5 funds and is managing over 310 million euros in capital. Goodwell provides early-stage equity to high-growth, high-impact businesses serving the underserved communities across Africa primarily, but also India. As you can see in the image below, from one of the recent funds, the Umuthu Fund, Goodwell has been able to scale its investments in 33 countries in Africa, focusing on replicable and scalable solutions in the fields of financial inclusion, agriculture, and other key sectors. This is a concessional investment because it directs capital towards underserved geography areas and also beneficiaries which are perceived commonly as higher risk beneficiaries. It differs from commercial capital expectations because commercial investors will not invest in companies serving people at the bottom of the economic pyramid. It is needed because it fills a capital gap. Goodwell has a validated investment platform to reach the underserved geographies, but in its major scale. And then the impact that it catalyzes is scale up successful approaches and companies. Especially at the scaling stage, blended finance structures are also commonly used to mobilize additional investments from different types of investors, including mainstream investors. Let's take a look at one of these structures by Cross-Boundary Energy, which finances the construction, operations, and maintenance of solar projects for commercial and industrial businesses in sub-Saharan Africa. The capital structure is the following. There is a Class A equity of 7.5 million. This is for 2016 structure. And this capital Class A equity is the senior tier in the fund, which is owned by private investors and the cross-boundary management. But there is also Class B equity, which is the junior tier of 1.3 million. And this is subject to first losses. And this was contributed by USAID in the structure. The Class B equity cannot comprise more than 1/5 of the fund, and it can only directly finance projects, so it cannot contribute to the fees or carried interest. Class B is repaid after Class A capital is returned to its investors, but the excess capital will be distributed pro rata among the two equity tranches. So this is concessionary because Class B has an undercompensated junior position compared to Class A. And it differs from commercial capital expectations because commercial investors would have demanded higher returns if they were in the junior position. It is needed because Class B investors can catalyze additional capital from Class A investors, and the impact is to fill a capital gap by financing solar projects in sub-Saharan Africa. The final role is the sustaining role, and it's rather different from the first two because it meets an ongoing, so a long-term or permanent need for capital that will accept concessional returns and or absorb disproportionate risk in order to maintain a focus on serving hard-to-reach beneficiaries or otherwise operate a business model that cannot achieve full commercial viability. For example, is the microfinance industry. While in large part the microfinance industry sector now is a mainstream investment opportunity that can attract also commercial capital, even through public equity funds, there are still certain elements or segments of the population that continue to require sustaining catalytic capital. Take the case of those microfinance institutions that are serving particularly vulnerable low-income communities in frontier markets, which have to walk the tightrope between affordable lending rates and high services costs. This may result in a business model that, while profitable, generates sub-commercial returns, and where profitability might be increased, it wouldn't be done without compromising the key impact objectives, so providing lower rates to the borrowers. Moreover, foreign investors in such microfinance institutions could face disproportionate currency and macro risks that are likely to persist in the long term. Credit International is an example of such a microfinance institution. It provides loans to more than 600 local partner organizations with the social objectives in about 6 countries worldwide. Through these partner organizations, Credit provides individuals and groups in low-wage countries who normally wouldn't have access to loans, access to appropriate financial resources. It has deployed over 1 billion in assets, operating from a very long term, and it has over 600 lending partners. It is concessionary because it pays sub-commercial returns to its investors. It generates typically a few percentage points. They vary from country to country, and you can check in your country how much they paid, but it's typically just a few percentage points. And it differs from commercial expectations because the mainstream microfinance returns are higher than what Credit offers. It is needed because with lower interest rates, Credit can provide low-cost loans to their borrowers, maximizing its impact. And the impact that it catalyzes is to sustain an approach of microfinance that needs ongoing subsidies to serve people living in extreme poverty. Another sustaining example can be Another sustaining example are community development financial institutions. They address the needs of basic financial services, affordable credit, and investment capital for low-income communities and individuals who are often excluded. They can be banks, credit unions, loan funds, microloan funds, or venture capital providers. The return of CDFIs may be lower than the returns of purely commercial capital players. However, their impact can have a unique impact and role in a community. For instance, the Low Income Investment Fund, or also called LEAF, is a community development financial institutions in the United States. It provides lending, grant making, and technical assistance with the mission of alleviating poverty. It focuses mostly on affordable housing, childcare centers, education centers, health, and transit-oriented development. LEAF has validated rigorous lending practices and internal controls that enable the company to reach over 600 million in asset under management in 2021. And as you can see from this image, the quite sizable impact at scale. It also received an A credit rating by Standard & Poor's in 2021. However, it pays rate of returns on its notes that are just a few percentage points based on the number of years of lockup. So these notes pay less than what investors could expect to get in other debt investments with similar lockup periods or the same vintage. It is concessionary because it pays sub-commercial returns to its investors. In 2019, their notes ranged from 1% return over 6 months lockup or 4% return for 10 years lockup. It differs from commercial expectations because fixed income investors in private market can expect higher returns with shorter lockups. It is needed because it fills a capital gap by investing in low-income communities, and the impact that it catalyzes is to sustain access to housing, childcare, education for underserved low-income communities. To summarize, here are some of the aspects that we discussed. Seeding targets unvalidated approaches and early stages innovation. Scaling follows seedings, and it takes validated approaches to reach new geographies and population, and often uses blended finance. Sustaining instead differs from the other two because it's not their natural evolution. It rather addresses impact outcomes which structurally need some types of financial risk or return concession, and often leverage validated approaches that have already been proven solution to scale the financing.